Since the dawn of time, our drive for a better life now draws the map of our future. And Sofia Tech Park is the home of innovation. Business, science, and education feel at home. The laboratory complex of the park is the cutting edge of progress. Total of 11 high-tech laboratory units, led by luminaries of Bulgarian science. Innovation is the focus of all the startup companies in the business incubator. Sofia Tech Park is home to dozens of young Bulgarian enterprises with a high-tech profile. Sofia Tech Park is the home of innovation.
Hi, my name is Yordan and I'm super excited to welcome you in our second episode of the videocast between two VCs. This is Symmetry's videocast about the world of startups, venture capital investing, innovation and technologies. In today's episode we are going to talk about the fundraising process and in particular the pitch deck, which is a very important part of that process. In Q1 and Q2 2021, Europe saw record-breaking venture capital investing in startups. About 59 billion Gs, that's a big number, billion has been invested in startups, and probably it all started with a pitch deck.
Hello everyone, and thanks Yordan for this opening. My name is Alexander, and I'm very excited about today's episode, which is devoted on one of the most important parts of the pitch deck, of the fundraising process, which is the pitch deck. We invited VC fund managers and successful founders who have raised millions of funding in the markets and asked them what are their recommendations for building a successful pitch decks. Our guests today are Pavel Velkov from Morningside Hill, venture capital fund based out of Sofia, Bulgaria, Virak Deshko from Lead Ventures, a venture capital fund from Central Europe, Sergey, who is founder and CEO of Polenity, Ivan Osmak from GTM Hub, Costa from Fire, and Ivan from Fantastic Stay. All of them very successful entrepreneurs.
Look, I'm not going to lie to you. The fundraising process could be a daunting task, especially for early stage companies and first-time founders. That's why you need to start early. You need to get prepared. You need to do your homework in a kind of systematic and strategic way. The first thing that you need to do, especially for VC funds like us, where we invest in early stage companies, is to prepare the pitch deck. Once you have that, and we're going to discuss that at length later on, you have to prepare a list of suitable potential investors, be it venture capital funds or angel investors or other type of investors. These guys need to kind of fit into what you're doing. They need to invest in the same sector or in similar sectors. They need to invest similar tickets. So you have to do your homework there as well. Usually, after that, if you get the interest of the investors, they will invite you for a meeting. You can go through iterations of 2 or 3 meetings where you can discuss different topics that are touched upon into the deck itself. You can discuss, the product, the pain point that you're solving, the problem. You can discuss the team itself, also the go-to-market strategy. So in all these kind of iterations, you will touch upon different topics, and then the VC, if it likes what he or she hears, he or she will do its own research, and then they will probably offer you a term sheet. This process may go for between 3 months to 6 months. It can be shorter, it can be longer, depending on the deal itself, depending on the stage of development of the company and the round itself. So, but usually that is the benchmark, and it can be a daunting task. You can go through different iterations. Just don't get discouraged. Robinhood, for example, they went through 70 iterations with 70 funds. They got a no. Just don't get discouraged. When you get a no, probably the reason might be, for example, the VC is not right for you. They have not understood the idea. They are in a different deal at the moment, so they're kind of swamped. So just don't get discouraged, keep on going, and eventually you will get it.
Yeah, I mean that's correct, Yordan, and the Robinhood guys. They even knocked several times on Wall Street doors before making the IPO. So courage is very important. But I have to interrupt you here because many people may don't even get to that stage of the fundraising process because I think that the pitch deck is perhaps the single most important item of the fundraising process, and you should really start with that. And it's like not having a pitch deck is like building a successful business without a website or something like that. But let's not wait too much and see what our guests think about the importance of the pitch deck.
Hi there, I'm so glad to be invited, so thanks for the opportunity, guys. I'm Virak from Lead Ventures, based in Hungary. I work as a VC investor, and with my team, I usually invest in scale-up companies in the CEE region, whose product, service has been validated by the market already, and typically earn sizable revenues. I believe I'm not telling a huge secret. The pitch deck usually is the first coincidence where the startup can express its intention for fundraising towards us, the investors. So actually, we have the first impression by reviewing the pitch deck itself. A well-built pitch deck can more easily catch attention and later, of course, can win among the others during the pre-selection phase. So the stakes are not less than to win an investor for yourself. All in all, it should be a compelling and a believable story of your company with a connecting and supporting elements and true convincing foundation.
Yeah, my name is Ivan Osmak. I'm the CEO and co-founder of GTM Hub, a company that helps other companies set, manage, and achieve goals. We use the methodology called OKRs, for objectives and key results. Originally, I'm from Croatia, and I've been now in Bulgaria close to 15 years, I think. And I came here back in the day to join Telerik. I think it's important, but nearly not as important as maybe I used to think back in the day. I think that a good pitch deck is just one of the, let's say, 5 or 10 things that you need to have to raise the money. So it's not the most important to think when raising money, but a bad pitch deck is surely can prevent you from raising the money. So I think it's something that needs to be done. It's not going to do everything on its own, but if it's done poorly or if it doesn't exist at all, it can definitely prevent you from raising money, I think.
Hi, my name is Ivan. I'm formerly known for BG Mama and Prodavanik in Bulgaria, and today I'm the CEO of Fantastic Stay. A pitch deck itself is a medium of communication and a tool to grab investors' attention. So in my opinion, having a well-made pitch deck will help you to illustrate your sales skills, and it's a good thing to have. That being said, it's not mandatory to have, because if you have good relations with the investors themselves and you can tell them your story, you can also have a good traction that way.
My name is Pavel Velkov, and I'm a partner at Morningside Hill Capital Management, a company that manages a VC fund in Bulgaria. Yeah, of course, the pitch deck is the centerpiece of your presentation materials. And as such, I believe it is pretty important in sparking the initial interest in investors.
I'm a co-founder and CEO of Fire. I'm second-time founder, and I'm a strong believer that focus and resilience makes your dreams come true. Well, maybe it's the second most important thing, as the first is always the team and your network.
Hi, I'm Sergey. I'm founder and CEO of Polenity, a company that brings innovative technology and methodology to the beekeeping sector. I would say that the right pitch deck should be viewed as the right CV for a job candidate. Just imagine this, a CV will never land you the salary you want or will negotiate the terms of your labor contract, but it will get you in the spotlight. So a pitch deck is extremely important to opening the doors. You should craft your pitch deck in a way that it's enticing for the VCs so that they want to hear you and they get a little bit excited of what you're going to tell them besides that pitch deck.
The winning pitch deck could be different for different people. It could be one for VCs and could be another for the founders. At the end of the day, we are all human beings. We think differently, our brains operate differently, our attention is caught in a different manner. For me personally, the pitch deck, the winning pitch deck is a storytelling exercise. This story should be coherent. It should has all the needed elements to provoke the interest of the audience, the reader, in this case, the investor or the VC. So it should be punchy, it should be very capturing, the story should be there, it should be compelling. Usually I look for for the problem that is solved, how it is solved. I'm looking for the size of the market, what is the team, I'm looking for the business model. So the question, it's interesting for me to understand whether it is the same for the founders and the VCs in terms of content, whether they think the content should be the same or not. Let's see what our guests have to say about this in the next video.
Well, I think there is always what a lot of people call like the money shot. So whatever goes really to the right and to the up, be it users, be it revenue, be it engagement, depending on the business. I think it's one of the things that every investor is going to take, and then so whatever it is, there has to be something that looks exponential, I think. The second thing is the vision, I think, and where all this goes, and that changes slightly from round to round as the company gets more mature, but it's always important. And then the third thing that I have found, especially when raising from institutional investors, is basically how you end up winning the market. So it's competitive analysis, and I think this is something in the beginning we didn't really pay too much attention to. But ultimately, in my experience, every VC wants to back a company that's going to win a category, and so that it has to be very clearly defined. I think the plan of how you plan to win the category and beat all the competitors.
The market always wins, say a lot of people in the US are stating, and this is where from I've kind of memorized this. So the market, how big is this? How big is the problem that you are addressing? What are the dynamics? This is maybe the most important slide in your pitch deck. Second one, I would put the team. Who are you? And what's your unique skill set that would help you to attack this market and take a great market share of it? And the third is, why now? Timing is everything. Why now is the time for this market to be attacked in the way that you are planning? Why your strategy will be winning right now?
So the three most important aspects for a VC pitch deck, according to me, are you should present a winning team. It's very important because everybody has a great idea. Everybody has some way to put innovation into work, but the team is the thing that is going to put this in motion, that is going to actually create the magical world that you're describing in your pitch deck. So accent on creating a very good story about your team. The place for this is normally in the back of the pitch deck, when you have already told a beautiful story about how you're going to make a lot of money, how you're solving a huge problem, and then It's the team that is going to create this reality. So team is extremely important. People normally neglect that. Two, it's not just one thing, but you should create a good story, as I mentioned. You should have all the different aspects of your pitch deck leading to something. They should be like a flowing story. The listener, in this case, the VC, should always be excited about what's coming next. So here's a great problem. This is so big. We need to fix this right away. Then this is how we're doing it. And then this is why this is going to make a lot of money for you and for everybody else. And this is the team that is going to do that. And the VC should be standing there just asking, so what's next? What's next? And the last thing that they should ask is, okay, how can I get in on this? So a good story is something that should be the motif of your pitch deck. And the third and probably the most important thing when you're speaking to a VC is the business model. The business model is normally something that people say, okay, it's super obvious how we're going to make money, but what you should communicate to the VC when you're pitching, especially in an earlier stage, is that you're extremely flexible. You have your business model in mind. You know where you are. You know where you want to be. You know all the business logic behind the different processes, but you should communicate that none of them is extremely vital to you, so that you're just flexible enough to navigate the storm when it comes.
As you are telling your own story, make sure that you lightly drip in traction as you cover the core components. Otherwise, we might think that you are telling about a fantasy. Don't forget, you want the investors to connect with you and be interested as fast as they can. If you fear they might think differently, show them and let them understand your real traction, which evidences the things that you are working on. For instance, how urgent the problem is. Bring the problem more alive and make your solution more credible by talking about your go-to-market strategy or delivery goals, so the audience will know how it really works or will work in the future. Secondly, what is the vision for your company? How is just the beginning, and how will your company reach the happy end and be a dominant player on the market? And I'm not referring to being acquired or making an IPO, but leading the segment with a supreme product generating flashy returns. And last but not least, consistency among the foundation slides of defining the problem, the solution, total addressable market, competition, and after all, the most crucial one, your exceptional approach, your uniqueness, that have to be well supported and associated by the foundation slides. The entire introduction phase must form a unit and give enough elementary information in order to build a story further.
The top three things that I believe that you should stress most in your pitch deck are target market. How big is the target? How big is the target market that you're after? You need to demonstrate very clearly to the VCs that the market itself is big enough for you to be a growth company. The second aspect is the value proposition. What are you offering and why is it different? How are you going to convince someone to buy your product versus the competition? Because chances are that you will have competition. And maybe most importantly, team. Depending on the stage on which your company or idea is, the team is going to be crucial. After all, you are going to be the people who are going to work towards delivering the goals and the promises that you're giving to a VC.
So a few of the more important features, I think, or qualities of a pitch deck are, first of all, I think, clarity of the presentation, of the idea presented, of the points you're trying to make. The second one would be I would like to see more detail, so more work invested, more time invested in preparing the pitch deck. And I also think that you should make it easy to understand for the average person. And I would suggest some people tone down the language in terms of less abbreviations. You can just spell them out, and less jargon used overall.
Okay, we saw the content of a pitch deck and the relative importance of the topics within the pitch deck. Let's talk now about the length and how detailed a winning pitch deck should be, according to our guests.
The pitch deck should be detailed enough to illustrate your idea, target market, and team, but you should leave the most details to conversations, as your potential partners, the VCs, would need to have the opportunities to meet yourself and get to know you better.
So winning pitch deck should not be as detailed as possible. What you should be striving for is providing just enough information so that everything is understandable, but not enough so that the people don't get excited about it. You should understand that VCs see a lot of different pitches every day. They see a lot of different innovations in action and potentially great, remarkable products. But they need to have this kind of magical feeling that, okay, so I don't quite get how are they going to do this. And if you create the right narrative, the one in which the VCs ask themselves the right questions, then you have a winning pitch deck. The winning pitch deck is the one that the VC is not going to put away, but is going to keep and say, okay, this one I want to hear, this one I'm excited to hear, and I want to speak to the people who have crafted this. So this is extremely important for a winning pitch deck.
In my opinion, it really shouldn't be that detailed. It's more of a teaser that opens more conversations. I think 10 to 12 slides is probably the best. And again, it should be something that should be used to start a conversation, not to finish it. I don't think that anyone ever got well, I didn't, and never heard of it, that someone got a term sheet based on a pitch deck. So I think keeping it short, keeping it interesting, and digestible is probably the best way to go about that.
I don't think it should be super detailed. As I have already mentioned, the objective is to connect the pitching founder, the story, and the investors who start buying into. Even they do not perceive the problem on their own skin. They have to be convinced that the problem exists and there is a unique solution for that, and you can be the one who will challenge the industry.
So every investment professional has a different opinion on the on what the pitch deck should look like, and of course on the level of detail. To me personally, I would like to see more detail because it gives me more information to work with, material to work with, and makes my it generally sparks my interest far better than a very skinny, I would say, pitch deck. So to me personally, more detail is always better, considering that it will also save on my personal research and save time for me.
Well, it depends. I would always recommend to have a set of decks. One pager that you can use to send to investors even before the first meeting to just spark interest. Pitch deck that you will be presenting live, which should not have a lot of text on it, and a richer text version, which you can send like 8 to 10 slides and appendix with more details if you wish to. which I don't think that's a good idea. But however, if you want to really you to consider that you have something more to say, just put it on the appendix, and the pitch deck that you'll be sending should be quite richer, because you're not there to give the details needed for your peers to fully understand your idea.
Well, that was very interesting video that we just saw, as some of the founders and the VC managers shared different opinions, and even one of the founders said that he used to do it in the opposite way, right? So at the beginning, he used to draft a detailed pitch deck, and then he switched to a 10, 12 pages, very punchy presentation. And to be honest, Yordan, I was very eager to see the answer of this video and this question, because even internally in our team, sometimes we share different views and different opinions about that. And it may turn out that it's quite personal, right? So for me personally, I prefer short executive pitch decks. You know, something that tells me your journey. You know, leaves me to do some research by myself, but it gets my interest, right? And for me, in the end of the day, a pitch deck is not an industry paper, or it's not a technical specification of your product or something like that. And I should not spend, you know, much time on this just because I don't have to. I don't have the time to spend so much time on this. And in my view, pitch deck is, you know, a sales channel. Is not a research paper or something like that. And I treat it like this.
Mm. Yeah, that's all good points, all very interesting points. In my kind of personal opinion, I also like short, punchy pitch decks. Ones that do not tell the whole story. They just kind of get me interested enough so that I want more. I don't want to see the whole data in there because I'm not gonna read it. I want to have that in mind when I have a discussion with the founder or the founders. So just kind of beyond that sweet spot where you get the interest of the VC or the investor, but also do not tell the whole story. Just entice them, you know, kind of enchant them. That's why I said before that it's a storytelling exercise at the end of the day, and a good storytelling exercise. If you're a good storyteller, you can sell a bad idea. But if you're a bad storyteller, you cannot sell a good idea. So this is something that to keep in mind. For me, just tell me your vision. Tell me the problem that you're solving. What's the pain point that you're actually tackling? What is the execution plan? That you have a plan behind that. And ask me, how can I help? This is enough. And this is enough, and you know, as Ivan Osmak said before, the pitch deck is not the only thing that is going to be needed for you to raise money. It's not a must in terms of it's not the only thing that actually can that you use. It's not the only factor, but it's if you have a bad pitch deck, it can kill your traction. It can kill your chances to get funding. That is why it is very important to start, you know, early, to get prepared, you know, to invest the time in there. Of course, you're gonna make mistakes. Of course, this is a learning curve for you and for all other founders that have raised money before you. It is important to invest the time. That is why what I recommend is to kind of to bounce around the pitch deck among your family and friends, bounce it around among friends that have already raised money. And that will give you precious feedback. Integrate that feedback in the pitch deck, and you will be good to go. You will be good to go.
Yeah, but maybe let's take a look at what our guests think are the most common mistakes in a pitch deck.
Yeah.
So some of the mistakes that founders often do in their pitch decks, I think, is speaking a lot about financials, especially when financials are not yet quite clear. What I'm speaking about is for an early stage startup company to start quoting their traction and to start quoting something like we have 20,000 visits on our website for the last week alone. This is not going to bring money. So some of this information, as big as it could be blown out, it's not exactly what a VC is looking for. So when you want to pitch your company, just find exactly what stage you are in and what is the thing that might get the VCs excited about helping you. Because the VCs are not just the people with the money. They're the people who want to get in on an interesting project. They want to make money out of it, but they want to be excited while doing so. They want to go in there and create a good environment for which to work, for which your team to work. But they essentially become part of your team. So leave this space open for them. Don't quote a lot of different numbers that you don't know where you got them from, why you got them. Are they actually essential for your business? Just stick to a very focused pitch deck. One thing that I want to do in all my presentations basically is framing. I want to go from a big frame to a smaller frame to the focus. So if my focus is to get money to subsidize my business right now so that I can create something big from it, then this is exactly where everything should be aimed. And some of the pitch decks, or a lot of the pitch decks that are not that quite good, tend to be not focused enough. They speak about all the different aspects of a pitch deck. They speak about the team, the business model, the problem, the solution, and everything. But at some point, they have just filled out the boxes. They have not created a good story, and they have thrown in a lot of different numbers. So our target market is $55 gazillion, and we're aiming to get 1% of that in the next few weeks. I mean, come on, stick to the numbers that you know and leave just a little bit of room for the VCs to get excited.
Well, one is being too detailed. Definitely, we did that. Another one is not having a story. Pitch deck is ultimately, in my mind, and I learned this from someone who has helped me a lot. is a story. So every slide should basically build on top of the last one, and it's not very different than writing a short story or an essay or something else. It shouldn't be just a bunch of slides put together. And yeah, I think the baby basically, as Antoine de Saint-Exupéry said, perfection is achieved when there is nothing left to take away, and not so any number that doesn't add to the story, any chart that doesn't tell the story, any image, I think should be removed. And this is something that in the beginning we were definitely making a lot of mistakes there.
So the most common mistakes I see is, of course, which goes back to my previous answer, is not having enough detail. The other thing is not tackling the weak points straight on. And yeah, I think not pitching the presentation to friends and family and to someone who doesn't know anything about your business before you start pitching it to potential investors, because most of the questions you'll get from potential investors, I believe, will have a pretty big overlap with the questions you'll get from those, let's say, initial pitches that you do. And I think that this helps a lot in terms of you can rework or just customize your presentation to answer some of those most, frequently asked questions, let's say.
It is quite general that startups stop their storytelling when they describe their product, because they do it on a feature by feature way. It is perfect to give us photos of the prototype or insert a short video, but it should not be a technical review. Investors must understand the use cases first and fast.
Well, one of the biggest mistakes that I've done while preparing my pitch deck is to put a lot of text in a pitch deck that I'll be presenting live. You want your crowd to be focused on you. You need to get attention and not to have your crowd looking and trying to read something you present. And something else that I've done quite often, especially in the past when I was just starting my entrepreneurship career, is to not focus that much on the market and on the why now, but focus too much on the problem and how we uniquely resolve this. And again, I repeat myself, market always wins. If you have a great solution to a small problem, then you cannot build a great company. So you need to focus on making clear why now and how and why this market.
Well, very insightful information, lots of note-taking time. I cannot add much more to this, just in my experience flipping through hundreds of pitch decks. Something that, I don't know if it's a mistake, but it really irritates me when it comes to the team slide, and you just, probably the single most important item when it comes to decision-taking about investing in a startup is the team topic. And when it comes to this slide, you only see a picture, a name, and the position of that guy. It pretty much, it speaks nothing. You don't understand nothing. It's really obsolete. And in order to assess the execution capability of the team, you need to provide more information. And that's something that really irritates me when I see just a photo of the team members. So this is for me a serious don't, that you don't have to include it in the pitch deck. But now I think that we should see what are the do's and what our guests are recommending we should include in the pitch deck.
If you ask me, I would highly recommend to insert a photo or a video of your product, the software platform, or even an MVP, helping your audience to engage in what you build. Secondly, do not share too much unnecessary information and not let the investors to be confused or lose focus. Feed them with the only needed data that build and support your storyline. In my view, these are the key of a winning pitch deck.
And my advice on how to construct a top-notch winning pitch deck is you should always try to put yourself in the shoes of an investor and try to understand and try to answer a few questions like, is it super clear what my product is going to, or product or service is about to do? Why is it going to be different? Why it should be a winner? And always ask yourself, if I was an investor, would I put money into this?
Yes, my recommendation to constructing a good pitch deck would be just invest a lot of time and work in it, because the deck, I believe, is the most important material. Everybody will see it, everybody will go through it, and I think that a lot of work and time invested helps a lot, in addition to just pitching your idea to, as I mentioned, having a mock pitches before you do the real ones. This will save you a lot of stress. It will save you a lot of it will just help you refine the deck, to help you make it more suited to your idea, specific idea at hand. I know that some people are using different templates or just using other people's presentations, and I think that this helps, but it also it doesn't always work, let's put it this way. So you just have to invest the time and effort in it. There is no other way around it.
I think one mistake that happens a lot is that somehow a committee does that. So maybe there is more co-founders or the whole team participates in this. It's ultimately, I think it's a creative endeavor, and there is an angle that someone should take. Typically, this is a CEO, but I think that's kind of one of the recommendations would be take it. It's like writing a blog post, talk to other people, get feedback, all of this, but ultimately, the person that's doing it should own it. And then the second one, I think I mentioned a few of these things, but it's already keep it short. Have open questions. Basically, have in your pitch deck things that are not completely clear, because ultimately you want to engage in a deep and detailed and meaningful conversation after this. So if all the questions are kind of answered in the deck, first of all, I don't think anyone is going to read it. Most of VCs go probably through 30, 40, 50 decks a week. And second, if all the questions are answered, you don't get to the next point, and that's basically a partnership discussions and going in more depth.
If I could give just two advices out of my particular history in communicating with VCs, number one would definitely be know your VC. So first of all, the VCs are humans. They're human people. They have emotions. They want to get excited about stuff, and their profession happens to be making a lot of money from investments. So if you want to have a winning pitch deck, if you want to have a good interaction with a VC, spend your time, do your homework, understand who you're speaking to, understand what are you going to be pitching to who, because if you stick with just one pitch deck for everybody, that's not going to work. That's not some sort of a talent competition. VCs are different, and they need to be enticed in different ways. So understand your VCs, understand how well they're schooled in the topic that you're going to be speaking about, because some VCs would really want to get into the details, and you should be prepared for that. And some would be really hung up on the problem that you're solving. So maybe understand if this is kind of an impact investor, understand where the investor went to school, what are other companies that sure he invested in the same area. Just know your VC, know your audience. That's extremely important. And the second advice, if I could give a second one, would be to really focus on what you want to achieve. The pitching to VCs is not just getting money, it's getting the smart money. It's understanding and evaluating your VCs as much as they're evaluating you, because you're not begging for money. What you're begging or hoping for is a perfect construct of a company, one that creates a lot of different products, the customers are happy, and it's just scaling and scaling and scaling. And you're going to achieve that when you have the right team, because the right team includes a few very good VCs.
This is not mine, but I think it's great and it's worth sharing. Write a story of your pitch deck. Don't start with the slides, just write it as an essay, just a story. As a story, it should have a great beginning, everything is going well, the world is happy, then a problem appears, and then you are attacking the problem and you resolved it, and again, everybody is happy. You should have epos, logos, and pathos, the three essences of a really great story. If you take a Hollywood movie, you will always see that it's developing this way. So you shouldn't bore people. It should be done in a way that is interesting and it's worth reading. The second advice that I can give, again, it's an advice that I've got from somebody that I really respect a lot, is to not be that focused on what the investors want from you to tell on your pitch deck, but to be rather focused on what you want to say and how you would like it to be understood. So a lot of investors have some really framework that they want to put you in. Just forget about these frameworks. Do the ways that you think the most will impact your crowd.
Well, I would say very helpful and insightful video. I can hardly give any, can single out any better recommendation than this. Probably if I have to answer this question and, put my money on two recommendations, at macro level, I would say keep your pitch deck executive and simple. And at micro level, really it's not exhaustive at that level, but something that I would like to see, and it's many times is not included in the pitch deck, is please convince me why I should invest in this business now. Why now is the moment? And that's something that not many times I see in the pitch deck. What about you, Dancho? What do you think?
Well, I share your opinion. I think that the pitch deck should be concise, punchy, very catchy in terms of content. The team should be mentioned, especially from the spin of the early stage investing, as we do, because the team is very important. If there is going to be any change in the strategy of the company, if there is going to be a pivot, and the chances that it's going to happen are more likely than not, it's going to happen. It is the team that is going to execute that. It is the team that is going to execute the vision, that is going to do all these crazy ideas and kind of make them reality. So I would very much also stress on the team itself. And that's also kind of coming back to what you said earlier about the team itself and what kind of bothers you when you see just a picture. So this is very important. And the pitch deck is, as we see, it's not the only single important thing when you're raising money, but it is very important. And probably not probably, but even the big guys have started with a pitch deck when they were raising money from VCs or early stage investors, family and friends, when they started early on. Even guys like Square that recently acquired Afterpay for 25 billion did that. And they start with the pitch deck. So you have to take your time and you have to trust the journey. The journey. This is the journey. You start with a simple idea. We kind of start to build your MVP. You get your early traction. You get a pitch deck. You go to fundraise, and this is the first steps in building a great and successful company. What is kind of interesting for me here is about this topic about how these big guys like Square have acquired Afterpay. What is the reason behind that thing? And we decided to start a new mini series called Deep Dive. We take a really deep dive in a theme that is important and that is interesting, that is relevant nowadays, and that is coming out of recent occasions that might be interesting for our audience there. That is why I would like to kind of give the floor to my colleague and partner Alex, who has done a very short view and kind of an analysis on the topic of Square acquiring Afterpay for $25 billion. Let's see the video.
Hello everyone, this is the first deep dive in between two VCs. My name is Alexander Terziski, partner at MV3 Venture Fund, and in this series we're gonna take it global. For about 5 minutes, we'll look into a major topic from the tech world and we'll try to make sense of it. And today's topic is a 25 billion acquisition in the payments industry. Last month, Square announced that it's going to acquire Afterpay in what's gonna be a massive acquisition for this industry, and it may turn out to be an iconic strategic play for Square, comparable to Facebook's acquisition of WhatsApp some years ago. But first, why we're so interested in that news? Well, as a venture capital fund with portfolio interest in digital payments, we would like to keep an eye on these developments. And second, we are obsessed with success stories, and these two companies are just that. Founded some 10-15 years ago, VC funded, made an IPO in the US stock market, and are on their way to become mega cap stocks in the market. So let's get back to the basics and see who Square and Afterpay are. Square is one of the leading digital payments companies in the United States, developing two significant ecosystems for merchants, known as Square Seller, and for consumers, Square Cash App. And Afterpay is a buy now, pay later company from Australia that enables consumers to split payments for purchases into 4 interest-free installments. So why did Square make this move to acquire Afterpay for such a large sum? Well, the short answer is easy: to create new avenues of growth and expand market optionalities. But let's take a look at the longer answer in order to see what synergies these companies can create combined. From a seller perspective, Square is serving millions of merchants, predominantly in the small and mid segment of the market, and predominantly in the United States. On the other hand, Afterpay is very well positioned in a large enterprise segment internationally and has a very strong position in the second largest market for Square, which is Australia. What's more, over 90% of Afterpay payment volume is online, and just below 50% of the entire payment volume of Square is moving through the online channel. Well, that's in a way understandable, as Afterpay core vertical is retail and online retail, and Square is after some brick and mortar businesses as well. Well, so we can say that Afterpay merchants base is incredibly complementary to that of Square. And on the consumer side, the addition of Afterpay embeds e-commerce more directly into the Cash App, and over 70 million Cash App users will now be able to browse through various retailers and use the buy now, pay later option at the checkout. This acquisition has the potential to link Square consumer brand with an extensive merchant distribution network and eventually create a powerful two-sided platform. It will help Cash App user acquisition in the United States and international, and it will improve revenue per customer for both Square and Afterpay user base. It will also accelerate Square international presence with improved value proposition and across various verticals. And as Square noted in their press release, competition is there, but no one has mastered the two-sided platform just yet. And having the ability for a seller to come in for the buy now, pay later, but also use the entire set of tools to run their business is pretty magical. I hope it all makes sense to you. Square is building a massive two-sided ecosystem in digital payments and e-commerce. And if you're an investor, I hope that you enjoyed your returns over the years and you're happy about this acquisition. And I hope that you enjoyed this episode of Between Two VCs and our deep dive review. Thank you.
Well, we just heard about a giant paying $25 billion for a company. We heard how the big dogs are doing that. They just thus they kind of boost their market proposition. They expand their footprint and at the end of the day justify the big valuations. But every time when I hear such a story, when I hear the number of like $25 billion, my rational mind starts to tick and starts to ask the questions: is this a justifiable justified valuation? Has Square, for example, in this case, overpaid? Is this just some kind of just a hype? Paying 44 times your sales for a company, is this a lot or it's not a lot? Is this justified or it's not justified? So what I'm interested to understand and ask Alex, because you are quite knowledgeable in investing in both public markets and also private markets. Do we see hype in terms of valuations of the companies, in terms of multiples? Do we see a bubble that is forming? Is this bubble going to pop? Sure. So this is something that is very interesting for me, probably for our audience as well.
Sure. Yes, and you probably guessed it. This is the most voted answer of our short quiz online, and this is our new mini series. You ask, we reply, no bullshit. So whether valuations are hype now or not, to be honest, I've been scratching my head about the valuation topic for about 16, 17 years. It's getting really philosophical already. You know, because conventional finance, traditional finance, they teach us that the value of the company is derived from the discounted free cash flow, and you know, for young companies, this figure is usually negative. So as tech investors, we should find a shortcut in order to value these companies, and this shortcut is usually represented in the revenue multiple nowadays. At first it seems that it's a simple figure, but it can get quite complex, what stays behind this figure, because in the end of the day it boils down to two questions for me that are kind of interconnected. The first question is for how long the company can stay in this hyper growth mode, what's the runway of growth, and the second question is in the end, when this growth slows down, what are the long-term margin structure for these companies. And you know, nowadays we hear companies raising money at 50, 70 or trading at 80 times the revenue, and we say, oh, that's crazy or nonsense or something like that. But as a VC investor, you know, you usually take a different perspective, because you try to work with a normalized revenue multiple, looking ahead 2-3 years ahead, right? If these companies are growing at 200% or 150% per year for about 3 years, the revenue multiple is going to be significantly lower, right? So what I'm trying to say is that you usually have a period of, I don't know, 24 months where you're in the dead zone, dead money. But after that, if the company remains in the hypergrowth zone and it's growing about 70-60% per annum, you see your money start compounding, and that's pretty okay. So it's really important that the company remains for as long as possible in this hypergrowth stage, and you have to, you know, analyze and assess this. And the other thing is that in the end, especially in the software industry nowadays, which is a relatively young industry, companies are operating at very high margins, gross margins of 70-90%. And now we see with some of the older software companies that they operate at stable free cash flow margins about 30%, which is a lot, and it requires higher multiple. So from that perspective, it's not about hype. But you know, what I see in public markets is also that good companies that are outperforming, they're very high priced, and average performance, they are being hammered. So it's, you know, that's rational. That's rational in a sense. But what I see in the private market, you know, in venture capital world, is that founders they start practicing revenue multiple comparison, right? So if the founder next door receive investment at 50% revenue, I should receive the same multiple. No, that's totally wrong, and that's hype, and we should be aware of this.
Yeah, so that is very insightful. Actually, that's very insightful, and for me, this kind of analysis and explanation kind of covers more or less the rational part of it. But let's not also forget that at the moment, you know, all central banks are pumping trillions into the system in the economy. This means cheap money for the funds, for their LPs, because they are hunting for a return, and thus these guys have a very cheap available resources to invest. We as a species are quite greedy. We want to get rich, you know, we want to have resources. So the fear of missing out is also there, and this is how our psychology works. At the moment, everybody wants to get into a certain, for example, category. They don't want to miss it. They want to invest in this company. They just don't want to kind of to miss all these opportunities, and the cheap money kind of accelerates that. So this is another side of the, you know, let's say it was what Alex told us was the rational side of it, and I was kind of, I'm always thinking about as well as the irrational way of making decisions, and I think this is valid. throughout the entire spectrum of life, not only about investing as well. So dear friends, thank you very much for your attention. I hope this was insightful for you. You are going to go home with these practical tips that we just gave to you, and also the founders and the VCs that were our guests. I hope that will be helpful for you when you go to kind of finance your next idea, maybe your next big thing, your next Facebook. We would be happy to talk to you if you have any questions. Something that I would like to mention for our next episode: if you go through the process of provoking this interest of the VC, and they decide to offer you a term sheet, we would like to spend the next episode discussing the term sheet. I think this is a very important topic. We will talk about what's the purpose of the term sheet. It's the foundational stone that you build on your relationship with a VC or investor that is going to last for 5 to 10 years until you either kind of go south, or you sell the company, you're very successful. And the term sheet has its idiosyncrasies. You have to be very careful about certain clauses. We will talk about them. We'll share our experience. We'll share our kind of, let's say, negotiation tactics to extract better terms. They have a rationale behind that, and I think it's gonna be super interesting. And you should kind of you should join our next video cast. Q3 and Q4 are going to be very intensive, very interesting for us. We're gonna announce some very promising deals. Just keep in touch and follow us on LinkedIn and all other kind of channels that we utilize. Bye for now. Thank you very much.
Thank you, and hope that you enjoyed this episode of Between Two VCs, and see you next time. Bye.
Cheers.